Imagine checking your investment account at the end of the year and discovering something unexpected. Your portfolio grew by more than you managed to save from your paycheck. For many investors, that eventually happens. And when it does, it feels like everything has changed. Some people even conclude that saving money no longer matters. But that's where many investors misunderstand what this milestone actually means. Yes, there is a point where investment growth can become larger than your annual contributions. The mathematics behind that idea are real. The conclusion many people draw from it often isn't. Today, we're going to separate the math from the myth. We'll look at why this milestone matters, why it's exciting, and why continuing to save can still improve your long-term financial security. Because understanding this one idea can completely change how you think about building wealth. Let's imagine two investors. We'll call them Alex and Ben. Both begin investing at the same age. Both contribute the same amount every year. Both invest for the long term using diversified investments. For the first several years, their progress feels slow. Every increase in their portfolio mostly comes from one place: their own savings. Each paycheck matters. Each contribution makes a visible difference. It feels like they're personally pushing their portfolio higher every month. Then, several years later, something interesting happens. Alex reviews his annual statement. He notices that his investments earned more during the year than he personally added. Ben reaches the same milestone around the same time. Both are excited, but they react differently. Alex thinks, maybe I don't need to save as much anymore. Ben asks a different question. What does this actually tell me? That single question leads to a much better understanding of how long-term investing works. Because this milestone isn't really about stopping, it's about changing. To understand why, we first need to understand the two different ways a portfolio grows. Every investment portfolio is powered by two engines. The first engine is your savings. This is the money you earn and intentionally invest. Early in your investing journey, this engine does most of the work. Imagine someone who has just invested their first $20,000. Even if markets perform well over the following year, the portfolio itself is still relatively small. Its investment gains are unlikely to be larger than another $20,000 contribution. That's why increasing your savings rate during the early years often has a much bigger impact than trying to earn slightly higher investment returns. Building the habit of consistent investing matters more than chasing exceptional performance. But this relationship gradually changes. As your portfolio grows, every dollar you've already invested begins generating additional returns. Those returns remain invested. Over time, they can generate returns of their own. This process is known as compounding. Compounding isn't a separate investment. It's the process of investment returns producing additional returns over long periods of time. The larger your portfolio becomes, the more meaningful those investment gains may become relative to your annual contributions. Eventually, some investors reach a point where the portfolio's annual growth exceeds the amount they contributed during that year. Financial planners sometimes estimate this crossover using a simple mathematical relationship. If annual contributions are divided by an assumed long-term rate of return, the result provides an approximate portfolio value where annual growth and annual contributions become similar. For example, someone contributing about $20,000 per year and assuming a long-term average annual return of 7% would reach that mathematical crossover at roughly $286,000. Because actual market returns vary significantly from year to year, this should be viewed as an illustration rather than a precise target. Many planners think of it as a practical range instead of one exact number. The exact crossover depends on future market performance and your own contribution rate. But regardless of the precise figure, reaching this point represents something important. For the first time, your existing investments are contributing at least as much to your wealth as your new savings. That's a meaningful milestone. But it's not the finish line. In fact, it's exactly where one of the biggest investing misconceptions begins. And understanding that misconception may be even more valuable than reaching the milestone itself. Let's go back to Alex and Ben. Both have now reached the crossover. For the first time, their portfolios produced more growth than they personally contributed during the year. On paper, they look almost identical. But what happens next is very different. Alex sees this as proof that his portfolio can now take care of itself. He decides to reduce his monthly contributions. After all, if compounding is now doing most of the work, why keep saving so aggressively? Ben reaches the same milestone but comes to a different conclusion. He sees the crossover as evidence that compounding is finally becoming powerful. Not that saving has become unimportant. That difference in thinking may not seem significant today, but over the next 10 or 20 years, it can have a meaningful impact. Because the crossover doesn't tell you that saving no longer matters. It tells you that the relationship between saving and investing has started to change. One of the easiest mistakes to make is assuming that long-term average returns happen every year. They don't. When people hear that stocks have historically delivered strong long-term returns, it's easy to picture steady growth year after year. Real markets don't behave that way. Some years produce excellent returns. Other years are disappointing. And occasionally, markets experience significant declines. History has shown this many times. That's why the crossover should never be viewed as a permanent achievement. A portfolio may generate more growth than your contributions during one year and less during the next. Future returns are uncertain. Your savings, however, are largely within your control. Every contribution you make increases the amount of money that has the opportunity to compound in the future. Think of it this way. Imagine building a snowball. At first, almost all of its growth comes from you packing on more snow. As it becomes larger, each full rotation naturally collects more snow than before. That's similar to how compounding works. The larger the portfolio becomes, the larger the potential contribution from investment growth. But notice something important. The snowball never stops benefiting from additional snow. Likewise, your portfolio never stops benefiting from additional contributions. Their role simply becomes smaller relative to the total portfolio. Imagine that markets fall sharply next year. Alex has already reduced his contributions because he believes compounding will do most of the work. Ben continues investing exactly as planned. Neither investor knows when markets will recover. Nobody does. But Ben keeps buying investments throughout the downturn. When prices are lower, each contribution purchases more shares than before. Eventually, if markets recover as diversified equity markets have historically done over long investment horizons, those additional investments also participate in the recovery. The important lesson isn't that market declines are good. They can be stressful and unpredictable. The lesson is that continuing to invest during difficult periods has historically been one way long-term investors have benefited from lower prices. Consistency often matters more than perfect timing. That's why many experienced investors focus on building habits instead of trying to predict markets. As your portfolio continues growing, something else begins to change. The questions you ask yourself become different. Early in life, most investors ask, "How much can I save this year?" Later, the more important question becomes, "How much income will I actually need in the future?" Those aren't the same thing. Retirement planning generally starts with expected spending rather than current salary. Imagine someone earning $180,000 each year. That doesn't necessarily mean they'll need $180,000 every year after they stop working. Some work-related expenses may disappear. Saving for retirement may no longer be necessary. Housing costs might change. Healthcare costs may increase. Travel spending could rise or fall depending on personal goals. That's why many financial planners begin by estimating annual spending instead of trying to replace employment income dollar for dollar. Once that number becomes clearer, the conversation shifts from accumulation to sustainability. Now, the focus isn't simply building a larger portfolio. It's understanding how that portfolio may eventually support future spending. And that's where one of the most widely discussed ideas in retirement planning enters the picture: the 4% rule. But despite how often it's mentioned, many people misunderstand what it was originally designed to do, and just as importantly, what it doesn't guarantee. This is where many investing conversations begin to change. Up to this point, we focused on growing a portfolio. Now the question becomes, how does that portfolio eventually support your life? One of the most widely discussed guidelines in retirement planning is the 4% rule. The idea comes from research published by financial planner William Bengen in 1994 and was later expanded by the Trinity study. Based on historical U.S. market data, the research suggested that an initial withdrawal rate of around 4%, adjusted for inflation each year, often supported a 30-year retirement under many historical scenarios. Notice the important wording: historically, often, under many scenarios. It was never intended to be a guarantee. Markets change. People's spending changes, taxes, inflation, healthcare costs, and longevity all influence retirement outcomes. Today, many financial planners also consider more flexible withdrawal strategies that adjust spending based on market performance rather than withdrawing the exact same inflation-adjusted amount every year. The important lesson isn't memorizing one percentage. It's understanding that retirement planning is about managing uncertainty, not eliminating it. But imagine two investors with exactly the same portfolio. Both retire with the same amount of money. Both withdraw the same percentage. Everything appears identical. But one retires just before a major market decline. The other retires several years after markets have recovered. Even though they started with the same balance, their outcomes may look very different. This is known as sequence of returns risk. It refers to the risk of experiencing poor investment returns during the early years of retirement, when you're withdrawing money instead of adding new contributions. That's why retirement planning isn't simply about reaching one impressive portfolio number. It's about building a plan that can withstand periods when markets don't cooperate. Many retirees reduce this risk by combining multiple income sources rather than relying entirely on selling investments. Depending on individual circumstances, that may include Social Security, pensions, bond income, dividends, rental income, or other reliable cash flows. Exactly which combination is appropriate depends on personal goals, risk tolerance, tax considerations, and local retirement systems. There isn't one solution that fits everyone. Let's return to Alex and Ben one final time. Years earlier, they celebrated reaching the crossover where investment growth exceeded their annual savings. Alex believed the hard work was over. Ben believed the real opportunity had just begun. Alex gradually reduced his savings every time his portfolio had a strong year. Ben continued following the same disciplined plan. He kept saving. He stayed diversified. He ignored short-term market predictions. And he adjusted his retirement planning as his circumstances changed. Neither investor could control future market returns. Neither could predict recessions or bull markets. The difference wasn't forecasting, it was behavior. Over long periods, disciplined behavior has often mattered more than trying to make perfect predictions. That's one of the biggest lessons behavioral finance continues to teach us. So, once your portfolio reaches the point where its annual growth is larger than your annual savings, celebrate it. You've reached an important milestone. It means compounding is becoming an increasingly powerful force in your financial life. But don't confuse an important milestone with the finish line. Saving doesn't suddenly become irrelevant. Its purpose evolves. Early in life, savings build the portfolio. Later, savings strengthen the portfolio, provide flexibility, and reduce dependence on uncertain market returns. Eventually, your financial success depends on both engines working together: your continued discipline and your portfolio's long-term growth. If there's one idea I hope stays with you after this video, it's this: the goal isn't to reach the day when saving no longer matters. The goal is to build a portfolio large enough that your savings and compounding reinforce each other for decades. Because lasting wealth rarely comes from one extraordinary year. It usually comes from ordinary decisions, repeated consistently, while giving compounding enough time to do what it has historically done best. Thanks for watching.